We're in a once-in-a-generation window for buying apartment buildings. And if you wait, you're going to be priced out for the next decade. And I'm calling this the multifamily gold rush because that's exactly what the hell it is. Over $900 billion, almost $1 trillion in multifamily loans are maturing by 2030 in the next 5 years. And owners who locked in 2 to 4% rates must now refinance at over 6%, and many can't refinance at that because their property's not going to cash flow. They're going to have to sell at a discount. This is literally a gold rush, but the clock is already ticking because once this stabilizes, once the rates stabilize, the opportunity is going to be gone, okay? So in this video, we're going to talk about the 5-year countdown, supply gut, rent softens, which equals distress, why the door slams shut by 2030. We only have 5 years to do this, how to capitalize on this with a 4-step game plan, my take, and then we'll wrap up the video. But before we get into the video, 90% of you aren't subscribed, so please subscribe to my channel to get more content like this every couple of days. Let's get started with the 5-year countdown. So take a look at this. This is the next 5 years, the multifamily debt coming due. We have almost $200 billion coming due this year, then 180, 160, 185, and 110. Check out the rate at origination. So it goes from 3 all the way to 4%. So 3, 3.4, 3.8, 4. So it just slowly ticks up. And then the refinance rate today, let's say we're at 6.4% rate today. Let's say we just kind of hover around there and it kind of goes down over time. There's still going to be a huge gap, but we kind of have 5 years to make this all happen. And the problem is that owners who bought, like these guys who bought all this stuff right here, they either can refinance at double the rate, right? It's going to blow up their cash flow on the deal. It's probably not going to make sense. The deal is probably not going to make sense or pencil anymore, or they're going to have to sell to buyers with fresh capital. Because if you come in fresh at these rates, you're going to be in pretty damn good shape, and you're just going to have to get a discount on this, which means these prices are going to go down. And you know, with all the inflation and all that kind of stuff, these prices should have gone up, but hell, they might be going down because of these loan originations, and people are going to be able to get in today at a much higher rate, which means that they're going to be able to price it into the numbers instead of buying it at super low rates like what they did. All right, so a couple other things to go over. There's been a supply glut, and there's also been a lot of rent softenings, which equals a lot of distress out there in the multifamily space. The reason for that is that Sun Belt overbuilt. Austin, Texas delivered 31,000 units in 12 months, and Class A vacancy hit 15%. Class A is supposed to be 3% vacancy, 5% vacancy. It's triple, like 300% more than what it should be. In Chicago, Illinois, where we have multifamily apartments, I think occupancy for our C-class stuff is like 3 or 4%. 3 or 4% vacancy. Class A, which is supposed to be the best thing to invest in. You always want to buy Class A, buy the best neighborhoods. It's hitting fucking 15% vacancy, and I'm buying C-class, B-class neighborhoods outside of the city core, outside of downtown, and hitting 3 to 4% vacancies in 2025. It's just wild, right? Nashville downtown is offering 8 to 12 weeks free rent to fill new towers. My brother actually just moved to Nashville, and he got 3 months free on a 12-month lease, or probably not a 12-month lease. Let's just call it a 24-month lease. 3 months free on a 24-month lease, and the free months were like the first couple of months. He had to pay 1 month in rent, and then he didn't pay for like month 4. It was wild, insane, and that's in Nashville. There's also been a huge cap rate reset in Phoenix. Phoenix used to trade at close to 4%. I know a lot of syndicators that were raising money and buying deals in Phoenix, and that market was booming. That's why I don't like investing in booming markets. Now it's sitting at 5.75% interest rate, cap rates. So when rents soften and debt costs double, NOI crashes, forcing motivated sellers. There's gonna be so many motivated sellers across the country, not just in Austin and Nashville. These are just two of the easiest like cities to pick on because they just went up like a rocket ship. And I called it. I knew that it was gonna crash because it didn't make any sense. Sure, there was a lot of people moving to these places, but not as much as they were building in these markets. So it's pretty crazy what's happening in Austin. Pretty sad, actually, what's happening with Austin and Nashville. That's, again, why I like to invest in places that are just steady Eddie. They've always been like that. They've been like that for 100 years. The population goes up a little bit, goes down a little bit, up a little bit, down a little bit, just like stay stable, right? I don't want a boom and bust kind of market that's blowing up and exploding with tons of new towers. I don't like that kind of stuff. I like to be more affordable housing where people can get a 1-bedroom apartment for $1,000 to $1,500. Like, that's my bread and butter, where I like to be. Why the door slams shut by 2030? Why do we only have 5 years, Antoine? The reason why is because inventory pipeline slows, so permits are down 30% year over year, so people are building less. Rates will eventually normalize, and cap rates will compress again. This is the biggest thing. I think that when there's been such an increase in interest rates from 3 to 6%, if rates remain at 6% for the next 10, 20, 30 years, or just say 10 years or 5 years, right? If they just maintain the same, everything is going to kind of normalize because you're not going to have this huge gap or cap rate kind of compression or interest rate compression or people in distress because there's this huge up and down of the interest rate. So if interest rates just stay level for 10 years, it's going to kind of normalize that and not create as much distress. And when you are buying multifamily or buying real estate, you really make your money when there is blood in the streets and there is distress out there. So for the next 5 years, before things do stabilize a little bit more with the current rates, because we've been at these current rates for the last couple of years, 5 or 10 years more of this stable rate is going to create less distress. And where we can make an opportunity is when we buy stuff during a distressful time and when there is blood in the streets. So distressed assets are going to get absorbed by funds with dry powder, because over the next 5 years, if you didn't buy when interest rates were super, super low and now you're buying, this is the best time to start a brand new fund. This is literally the best time in my lifetime to start a brand new fund. Maybe 2009, 2011 was another amazing time. Taking that and then selling everything in 2020 would have been you would have been golden. But I think now is probably the second best time in my lifetime to be able to go out there. Obviously, I couldn't start a fund in 2010. I was 15 years old, so I couldn't have done it. This is the only time in my adult lifetime where it would be a great time to start a fund and start buying multifamily real estate, and that's exactly what I did. So if you do want to invest with me and buy multifamily real estate over the next 5 years with me, and you are an accredited investor, click the link down below, top of the description, book a call directly with me. Let's chat about how we can get you into some of these deals. Cool. Tax advantage opportunities, bonus depreciation, OZ step-ups, sunset by 2027. This is actually just extended. So we got bonus depreciation extended to be 100%. That just went into effect. So I think we got another 5 years on that, let's just call it. So we're out to 2030 for the bonus depreciation. I'm just assuming a new president's going to come in and probably offset that or make it go down again. So we'll see what happens with that. But bonus depreciation is back up to 100%, and let's just say that happens for the next 4 or 5 years, and then it's eventually going to be offset. Okay, how can you capitalize on this opportunity, the multifamily gold rush? First, you're going to map loan maturities. I want you to kind of maybe go and look at different data, look up the market that you're looking at investing in, how many loans are having expirations for the next couple of years in your market. If there's not that many, then it might not be a great place to go out there and buy right now. You might want to find a place that does have a lot of these that there's going to be just more blood in the streets. Okay, so you might want to also target high supply submarkets like Austin, Nashville, Phoenix, Raleigh. Lots of new product, falling rents. That could be a good option. Also, just where you're currently investing, where you have a team, where the price per unit is a affordable rate for you to be able to get into that market. For me, I'm doing Chicago, Cleveland, Cincinnati, Detroit, St. Louis. Those kinds of markets are the markets that I'm kind of targeting just because I know them and I've been investing in the Midwest for 10 years now. All right, I want you to line up fixed debt. Freddie Mac, Fannie Mae, agency fixed 10-year or assumable HUD deals, lock the rate gap. Right now, you should be able to buy a deal if you have real estate experience with Freddie or Fannie. You should be able to get 6% to 6.5% interest rate. So I would go and line up that fixed debt and raise capital now. If you do want to start your own fund, want to do your own deals, I can certainly help you start your own fund if you want to do that. LPs love distress stories with clear upside. It's just been harder to raise money from LPs. LPs are people that invest in your deals, right? If you wanted to buy a building and you didn't have enough money to do it yourself, you would raise money from what are called LPs or limited partners, and you would still sign on the loan. You would be the GP or general partner. It's hard to raise money right now, but it's the amazing time to buy deals. So there's always going to be, it's always this kind of pendulum. It's when there's so many deals out there, there's blood in the streets and all this kind of stuff, it's fucking hard to raise money. And then when things are good and everyone's making money and all this kind of shit, there's no deals. But people would invest in fucking anything. And that's kind of what I feel what happened in 2017, 18, 19, 20. Rates were low, everyone was making money, blah, blah, blah. COVID, boom, interest rates skyrocketed. It's been kind of Slumpville for the next 5 to 10 years, but a lot of people haven't really been hurt yet because they haven't had to refi, they haven't had to sell, they haven't had to cash out of their properties, and they've been getting a lot of loan extensions in the hopes that the rates are going to come down. But I think that a lot of those lenders now are going to be like, all right, we've extended this 3 times, 2 times for 3 years, 2 years. Like, you need to eventually just refinance this thing or sell it. All right, so those are kind of some ways to capitalize. Look at the market maturities, target some markets, get fixed debt, raise capital now, or just take your money and invest it into somebody else's deal, like myself. And again, if you want to book a call with me, click the link top of the description. So my take, I'm buying every deal that I can that covers debt service day one. I want to buy buildings that are fully occupied with today's rates that still cash flow. I want to be cash flowing close to 10% annualized. Has forced sale pressure. So I want something with a loan maturity, partnership dispute, where I can get a good deal. Sometimes it could just be as simple as bad management, poor management, somebody wants to upsell or do something like that. So, but there's a lot of deals like this where there's kind of like something pressuring them to sell, or they really want to sell, or they're trying to buy a new building or something like that. So I want something that cash flows day one. They need to sell the building for whatever reason. And sits in growth corridors with temporary oversupply. I would focus on this, like sits in a growth corridor. I want to invest on the fringes, invest in C-class neighborhoods surrounded by B and A-class neighborhoods is what I like to say. So I would invest in those areas that are on the fringe, that are on the borderline of a high growth area. You can buy those buildings super cheap at a 50 to 100 grand a door, and then 5 minutes away, 2 minutes away, it's 200 grand a door. Like, that area, if you look at it correctly and know the trajectory of the city, is eventually going to appreciate, okay? Once capital markets loosen up, this inventory vanishes. Wealth will shift from over-leveraged 2015 to 2020 buyers to prepare 2025 to 2029 buyers. Question for you guys, what market do you think will crack first, Austin or Nashville? Which one are you seeing kind of crack the most right now? There's been so many markets over the last decade that have just blown up. And I think a lot of those markets are going to come crashing down. I live in Miami. I moved here post-COVID, 2022, 2023, and I'm definitely seeing that oversupply happening here, but it's a little bit late past Austin or Nashville. But a lot of new construction projects in Miami are now offering 2 months free, 1 month free, 3 months free. So I'm starting to see it kind of slow down. And there's a lot of other videos out there on the internet talking about how Miami home prices are softening. It's been the lowest amount of buyers ever in the history of Miami, something like that. So there's a lot of stuff happening right now in Florida as well. So I think Austin, Nashville, Florida as a whole, Tampa, especially Miami, lots of stuff is happening and it's kind of softening these markets. So with that being said, thanks for staying till the end of the video. Make sure to like and subscribe to my channel so you get more videos like this. Tell me what you're investing in right now. Where are you investing? What are you buying? Are you investing in multifamily? Are you going to invest in multifamily now after watching this video? Because this is going to be the next 5 years of our life. Is going to be this right here. All this multifamily debt coming due. $250 billion worth of real estate almost every single year is going to be listed for sale because this is just the debt. So $250 billion of real estate every single year for the next 5 years is going to be listed for sale, and they're at super low rates. So let's see what happens over the next 5 years. Thanks for watching until the end of the video. See you on the next one.